If you've been watching our learning modules, you've heard us mention the NIFTY many times. You probably already know what it means. It stands for the National Stock Exchange 50, and it's an index of the 50 largest stocks that trade on that exchange. Let's talk about why you need an index like this in the first place. The idea of an index of equity market stocks is that it helps you get an indication of changes to economic activity. A change in the value of an index is thought to be related to how economic conditions change. If we want to make that jump to economic activity, then that index should be constructed carefully, shouldn't it? It should, for instance, at least include some of the bellwether stocks in that economy. There are, for instance, 5,000 stocks in India, but only 50 appear in the NIFTY index and 30 in the SENSEX, which is the other widely followed index in India, right? And there is considerable overlap between the NIFTY and the SENSEX. The reason why we don't include so many of the other firms that are listed for trading on these exchanges is that those stocks are sometimes small. Very often they don't trade actively for days at a time, sometimes even weeks. We don't expect them to reasonably capture or meaningfully matter to how economic activity is being suggested in the country, right? If you do want a broader measure for India, there is something called the CNX 500, which I believe is owned by the Standard & Poor's people now, which gives you a slightly broader measure since it captures the price activity of 500 stocks as opposed to 50 or 30 NIFTY or SENSEX. In addition to serving as a gauge of economic activity, a second and perhaps more useful to some value of having an index is that it serves as a benchmark against which portfolio managers, mutual fund managers can evaluate their performance. You might have noticed, if you own a mutual fund or have looked at a mutual fund prospectus, that many mutual funds, especially those that manage equities, list the NIFTY or the SENSEX index as their benchmark. What does that mean? It means that suppose the NIFTY in a given year earned a 12% return and the mutual fund that specified the NIFTY as its benchmark earned 12.5 or 13, then the mutual fund manager can happily say that they beat the benchmark and therefore they should be compensated for it. And in fact, for many mutual funds, performance against the benchmark is what drives the compensation that the managers of those mutual funds actually earn. We talked earlier about the NIFTY and the SENSEX, about the 50 stocks in one and 30 stocks in the other. But we didn't really talk about how each of those stocks were weighted in the index. And this actually matters. And let me tell you a story why it does. Way back in 1901, something called the Dow Jones Industrial Average was created in the US. It's probably a name some of you have heard. It really doesn't matter even if you didn't. But what is important is how those guys went about constructing an index. They picked 30 stocks. They took the prices of those 30 stocks, added them up, divided by 30, called that the Dow Jones Industrial Average. What that means basically is that each stock was weighted by its price level, right? Now think what might happen to an index built in this fashion. Suppose one of the stocks in that index splits 2 for 1. What's a stock split? It means basically that the price gets cut in half, 2 for 1, and the number of shares outstanding doubles. Nothing has changed about the company. Nothing fundamental has happened to warrant any implications for economic activity. But if you use the price to measure this index, the value of the index would have changed. So let's think about how Dow Jones people decided to deal with this. It's not as if they didn't know. Suppose there are 2 stocks in this index with prices of 50 and 100. The index value is 75, obviously. Suppose next that the second stock splits 2 for 1, its price goes from 100 to 50. Because of this, the index value changes from 75 to 50. It has dropped by 33% when nothing fundamental has really happened. What the Dow Jones people did to bring this back up to 75 before the split was to change the divisor from 2 for the 2 stocks in it to 1 1/3, and 50 plus 50 divided by 1 1/3 is back to 75 again. That's how they accounted for the split, because that's how they built the index in the first place. So it takes us back to the point of how should you build an index instead. Returning again to that index business, the divisor has had to be changed so many times that its value at present is like 0.12. This is why you see nonsensical sounding things like the Dow Jones average is at 27,000 when the price of the biggest stock in it, rather the stock with the largest price, is Boeing at 380. Some barometer this turns out to be. I wonder why people even bother to look at the Dow Jones averages at all. Seriously though, if the price weighting business doesn't work, and we just showed you why it didn't, what is a better way to weight things? People started to play with weighted averages. A common trend, still popular to this day, began that you weighted each firm's price not equally, but by the proportion of its market value to that of the total market value of all the stocks in that index. What this does is that by making it a weighted average on market value terms, that business about splits messing up the index doesn't occur.